Hi, I'm Dan Costa, editor-in-chief of Worth Magazine, and welcome to another edition of Worth Knowing, where I have the privilege of talking to leaders in tech, business, and policy who are changing the way we live, work, and play today. Today, we're going to talk about business. We're going to take a deep dive into the economy. There's a new generation of investors out there that have only recently experienced inflation. It's something that many generations have just not seen in years. But inflation is back, and I'm here to talk to somebody about how to manage that risk. Today, I am here with Nancy Davis. She's the portfolio manager for Quadratic Interest Rate and Volatility Inflation Hedge ETF. In other words, IVOL, the much shorter way. It is listed on the New York Stock Exchange. Nancy Davis is the founder and chief investment officer of Quadratic Capital. She's also the portfolio manager for both IVOL and BNDD ETFs. You may recall that IVOL was named the best new U.S. fixed income ETF of the year when it was launched in 2019. Before founding Quadratic, Nancy was the head of credit, derivatives, and OTC trading at Goldman Sachs Prop Group. Barron's has named her one of the 100 most influential women in U.S. finance. Nancy, thank you so much for joining us today.
Great to be here with you, Dan. Thanks for having me.
So let's start with this concept of that I've been hearing around a lot. I've tried to wrap my head around the inverted yield curve, which is something that is shaping the economy, something you know a lot about. Can you explain what that actually means in terms of dollars and cents?
Yeah, so everybody's been talking about the Fed hiking rates. The Federal Reserve Bank only controls the policy rate. So that is the overnight lending rate. So when banks put money at the Fed, that's the interest rate that they receive. The Fed has just embarked on one of the fastest hiking cycles we've ever seen in our lifetime. And we have policy rates now above 5%. The inverted yield curve is the market's expectations of rates at different points in time. So there are a lot of different yield curves out there. You can have the Treasury yield curve, SOFR yield curve, which has replaced LIBOR. Anything that has different interest rates at different maturities has a yield curve. What we specialize with inside the IVOL ETF is the 2s, 10s yield curve. So what that is the difference between the 2-year interest rate and the 10-year interest rate. And that is massively inverted. As you said, Dan, it's more inverted now than it was even in the late 80s after we were coming out of periods of very high inflation.
So, I mean, and to put it simply, like money, you usually think that the longer you put your money into something, the higher rate you're going to get from it. And when it's inverted, the short-term money is actually making more interest than the long-term money.
Yeah, it's a really unusual thing to have an inverted yield curve. It hasn't happened many periods in our lifetime. It's really been since the 80s, only 4 occurrences when the yield curve inverts. And it's a weird dynamic, like very simply, if I was to, ask you for a loan, right? And I said, hey, Dan, can I borrow $100? And then I'll say, I'll pay you back tomorrow. I pay you back in a year. I pay you back in 10 years. It's just normal that if you're giving me money longer, that you would expect some sort of higher yield. Right now, you actually get paid lower yield than you can get overnight, even short-term rates, because the yield curve is so inverted. So what that means is a lot of investors have been worried about the Fed hiking rates, worried about inflation, and they're what they're doing is they're rushing and buying 10-year treasuries, because a lot of the models, like the CAPM model, they say 10-year treasury is the risk-free rate. Well, not really. I mean, it still has duration risk. It's still very sensitive to interest rates. And right now, the 10-year interest rate is way below the Fed's overnight rate, and the yield curve is so inverted. And so it's really a weird time in the markets where kind of everybody's been expecting this recession. We haven't really had it, but when the yield curve starts to uninvert, that's typically a sign that the recession is coming.
So you're faced with this scenario and this not unprecedented, but certainly non-traditional pattern. What's your approach with IVOL? Like what makes it a unique fund?
So IVOL is mostly U.S. Treasuries. About 80% of the fund is U.S. Treasuries and cash per our prospectus. We use the inflation-protected Treasury market, which is a really new market. Like a lot of people look at what happened in the 70s and 80s for inflation protection. And I like to grab people and say, hey, you know, the inflation markets in the United States, the US Treasury just started issuing inflation protected bonds in the late 90s. So it was 1997. So if you go back and you look at what happened in the 70s and 80s, you don't really have an inflation market. There were no derivatives markets. There was no even inflation protected bond market. And so it's really important to be thinking about what that's going to mean in the future. And the problem, you know, when I started my career in the late 90s at Goldman Sachs, that was right when the US Treasury started the TIPS market. And I remember, you know, I've always been sort of a lifelong dream of mine, because I always remember thinking like how crazy that is that anybody would use one index, right? The TIPS market, which are Treasury inflation protected securities, they reset with the consumer price index, the CPI, right? And we hear a lot about CPI, but even the Fed doesn't only use the CPI. And that's where IVOL comes in, is we access another measure of inflation outside of just the CPI. It's like, you know, nobody would buy the Dow Jones or the Russell or the NASDAQ or the S&P and say, ta-da, I have the US equity market. Why would you do that in the inflation markets, especially with the index like CPI, which is calculated by the Bureau of Labor Statistics, and a third of that index is what they call shelter, and I use air quotes because it's actually owner occupied rent. So IVOL takes the Treasury portfolio, the Treasury inflation protected securities, and then we try to fix the problems that exist with that type of Treasury bond alone.
So it's basically diversifying. So you're not just using tips. You're adding more things into the portfolio.
Yeah. So the only thing, it's actually pretty, it's very different, right? But all we're adding is options that benefit from either falling short dated rates. So when the Fed cuts rates, or when long dated yields go higher, which is when all bonds lose money when yields go higher, because all bonds are long duration. Even that's one of my pet peeves, like short duration is still long duration. It's just less long. It really should be called less long duration. So a lot of investors in today's environment are saying, oh, we're worried about interest rates. So their solution is to buy short duration, but short duration still doesn't make money when long dated yields go higher. It just loses less money. And a lot of these strategies take a lot of credit spread risk, whether it's, you know, with mortgage market or different types of structured products.
So what's the main innovation that access to IVOL brings to the market?
Yeah, so IVOL is an inflation protected bond strategy that tries to fix the issues with TIPS alone. We do that by owning optionality. So what I mean by that is we buy options. Very simply, when you buy an option, the most that you can lose is the premium that you pay. And the inflation markets are pretty risky because it's not like buying a stock or buying a bond, because there's no zero bound, right? Inflation can go negative. It's not bounded by zero. So we like owning inflation expectations outside of CPI in option format to actually profit when long dated yields go higher or when the Fed cuts rates. So if we look back, you know, IVOL's been around over 4.5 years. We pay out a monthly distribution. Historically, we've paid out 30 basis points every month, but that distribution does not take credit spread risk. Like most strategies, if you take, say, an investment grade bond portfolio, you have sensitivity to interest rates, which is your duration. And then you also have the risk that credit spreads, you want them to tighten. We want interest rate spreads to widen in our strategies, meaning the yield curve to uninvert with IVOL. Would you like me to share maybe a chart of the yield curve to
Yeah,
show
yeah. Show
kind
what it
of?
looks like, because this was in our prep calls. This is something that really made it clear to me that it literally illustrates the sort of strangeness of the situation.
The chart starts in the late 80s when the swap market started, right? The interest rate derivatives markets are not that old. The inflation protected bond market started here in the late 90s when the US Treasury started issuing TIPS, which are Treasury inflation protected securities. And you can see this red line here is zero. So the number of times, in the history of the swap markets that the yield curve has gone negative is very few. It was here in the late 80s. It was for a hot second before the tech bubble. It was before the global financial crisis. It was very briefly, IVOL was actually listed in the fall of 2019. So you can see the performance and see how we underperformed TIPS during that period when the yield curve inverted. And then it's now. And now you can see is lower and longer than it's ever been in the history of the swap market. So it's a really weird time that, the current yield curve is negative 78, meaning a 10-year interest rate earns less, 78 basis points less than a 2-year interest rate. So IVOL has, the way to benefit from this uninversion or the steepening of the yield curve, meaning going from less negative to hopefully zero and positive. Normally, if you look at the median and the average over this data set, you can see that normally the yield curve is upward sloping. And I think it's also important, if I can click over to this screen, hopefully you can see it okay. This is the global
Yep, we can see it.
yield curve. So this is looking at, this is not all markets. This is a selection that we monitor through. These are all Bloomberg codes that you can see that are pulling in data real time. And so you can look at the current consumer price index, which again, just an index. And then you can look at when there's an inflation protected bond market, the break even. So that's where CPI needs to be in the future to make it better off for an investor to own inflation protected bonds. And you can see the Fed has achieved with their jawboning the conviction in the market that the long-term inflation will be around 2%. You can see the 5-year, the 2-year break even. But then if you look at this is nominal bonds, meaning the treasury bond market, and then this is the swaps market. You can see that the US has one of the most inverted yield curves in the world. Even things like Japan, Japan's still doing quantitative easing, they're still doing bond buying, and their yield curve is positively sloped. It's positive 70s, and ours is negative 78. So it's really a very, very unusual time in the market. And because of this inverted yield curve, IVOL's performance has been pretty bad recently. So I think it's important to highlight, we benefit from this line going higher, and it's been lower, more low. Like you can see back in the 80s, the yield curve was, around, I think the absolute low was around negative 60, call it, just rounding. And so right now it's lower than it was in the 80s, and it's been that low for a really, really long period of time.
Excellent. So how does the IVOL react to like stressors that hit the market? Like we recently had Silicon Valley Bank going under, that sent shockwaves through the market. Like how did IVOL react to that?
Yeah, so IVOL had very great performance for the week of Silicon Valley Bank. I don't want to cherry pick that period, but you can look back and Google it. There were a lot of articles written that it was we were up about 15% that week, and that's because the fund buys interest rate options. We buy interest rate options on the yield curve, and when the market has stress, the volatility levels rise. And whenever you buy an option, you're actually long volatility. So a lot of people think about the VIX. The VIX is just equity volatility. So we don't own any type of equities at all inside the fund. It's we use a Bloomberg TIPS ETF to access the treasury market to we've not had capital gains tax because we've been able to use the ETF technology to access the treasury market. And the options access interest rate markets. And so the fund is actually long interest rate volatility, which is very, you could say, like, why do I care about interest rate volatility? Most people are short interest rate volatility in their bond portfolio. And that's because if you think about what is a US mortgage, right? Mortgages, because a lot of these indices, like say the ag index, right? It used to be the Lehman ag, then it was called the Barclays ag, now it's called the Bloomberg ag, but it's a really old index. Let me maybe share my screen with you to show a picture of it. It's an old index and it doesn't have any inflation protected treasuries in it at all. So no inflation protection, even though a lot of people consider this core fixed income. A third of that index is US mortgages. So in the United States, if you own a mortgage with your home, you can prepay that loan whenever you want. So if you think about it, a homeowner is long the option to prepay. The owner of the financial mortgage is actually short options to homeowners. And whenever you're short options, you're short vol. Whenever you're long options, you're long vol. So IVOL is a long volatility. It's long interest rate volatility, which a lot of model builders use to reduce that. Sometimes it's called negative convexity that exists with US mortgages. But basically, when interest rates move higher, homeowners are rational and they don't prepay as quickly. So the duration extends in their portfolios. You can look at, Silicon Valley Bank's 10Q, and you can see in the footnotes that they had a lot of mortgages, and when interest rates move higher, they got longer duration faster. And so IVOL is very a nice complement to core fixed income because it adds inflation expectations outside of CPI, and it can also reduce the kind of natural short volatility that most people have because these indices have so much of an allocation to mortgages now.
So you mentioned earlier your distributions. I want to make sure we maybe double tap on that a little bit. What has your distribution history been like at IVOL?
Yeah, so let me maybe share. Can you see the fact sheet for the fund?
Yep, it just popped up.
Great. So we've been the fund's about a little over 4 years old, and we've paid out 30 basis points of distributions every month since the fund started paying distributions in the summer of 2019. So it's been over 4 years, 30 basis points every month. The distribution is taxed in a very interesting way. If you go to the second page of our fact sheet, you can see that we because we're accessing this market, the rates market, we are actually taxed as ordinary income. So the options, like last year, for instance, in 2022, we had no tax on the monthly distribution because it was all taxed as return of capital. So it's not that you never pay taxes, it just changes, it reduces your basis so you can delay paying income taxes until, so it's a nice long-term holding from a taxable account as well. It's not always going to be tax-free. It depends whether the options make money or not. But we do have, when the options lose money, you get the potential benefit of getting that distribution sheltered. A lot of people will use munis for their fixed income, to be tax advantaged. So we take no municipal risk, no credit risk. It's interest rate risk. So it's just something different. And it's not always going to be tax advantage, but it could be if the options do not work.
So the big question is, what is the Fed going to do next? They've sort of been on the fence at the end of the current hiking cycle. We don't really know which way they're going to zig or zag. Do you think this is a good time for investors to look at IVOL?
Yeah, I do think it is a good time. We just showed the chart of the yield curve. The yield curve normalizing, so meaning going less negative, can happen. Let me just share my screen, for a lot of different reasons, which I think is nice. If you think about most bonds and investor portfolio, there's really two ways to benefit. Either you have credit spreads tighten or yields go lower. This strategy, the options don't really care about the level of interest rates. We just want the yield curve to move less negative, or volatility to increase, which is typically happens in stress environments when people, want their equities diversified. And also we have exposure to real yields, and real yields are very positive right now. So we want lower real yields because of the tips. So all the components of the strategy are, have not had great performance recently because the Fed has really convinced the market that they are going to kill inflation in the future. And I think that's one thing that a lot of people are thinking of inflation more as a trade and less of a asset allocation. If you think about, your portfolio, right? And especially as you go into retirement, you're probably not in the labor market anymore. So if inflation sticks around for longer, you have, a higher cost of living, and you're not going to benefit from any kind of wage inflation. So in my opinion, I think most people should have some allocation to inflation in their portfolio. And the problem is a lot of these indices are tied to the ag index, which doesn't have any inflation protection in it. And a third of it is short volatility from the mortgages, like we talked about. So I think it could be a really nice portfolio diversifier. Of course, it's not, the whole point of having a diversified portfolio is not to have everything lose money at the same time. And on the flip side of that, not everything is going to make money at the same time, right? We got a lot of investors got very lucky up until 2022 when stocks and bonds after the financial crisis were all going up together. But if you have everything going up together at the same time, you're probably not as diversified as you may think. So IVOL doesn't take corporate credit risk like high yield or investment grade bonds or levered loans. There's no corporate credit spread risk. We take interest rate spread risk, which is something different. And all investors should consult their financial advisor, read the prospectus that's available on the fund's website, and see if it's an appropriate, tool for you. But it is something really different. And a lot of people have exposure to interest rates, because of their housing, right? Everybody needs a place to live, whether you're a renter or you're a homeowner. And most real estate investors will try to hedge their interest rate exposure. And so IVOL was, as you mentioned, awarded, kind of giving a shout out in 2019 against, there were funds nominated from BlackRock and Goldman and Van Eck and Nuveen for that award, and we were really proud to receive that because it is something different. There's very little, I'd say, innovation in financial markets. A lot of the strategies do kind of the same thing plus or minus the benchmark, and this is definitely really something different.
So I think maybe that's a lot of the investors are sort of used to their predetermined buckets of where they're building their portfolio from. I mean, it sounds like IVOL is something, obviously this fund is only a couple of years old, but how does it fit into, how would you recommend it fit into people's portfolios?
Yeah, so a lot of people today build models. So they have model portfolios that are, using the ag, and so a lot of investors will use it as a complement to the ag index, where they'll add a portion to IVOL to add inflation expectations, and reduce that short volatility. Some other investors will use it as a diversification tool to not add more credit spread risk. If you think about, there's really only two types of bond risks out there. There's, duration, which is your interest rate sensitivity, and then there's spread risk, whether it's agency spread risk with mortgages or credit spread risk, which, if you think about all the different strategies out there, they all take credit spread risk with, investment grade bonds, high yield bonds, floating rate notes, even private credit. It's taking a company and giving them essentially a loan, and you're hoping that their expenses are lower than their revenues, and fingers crossed there's a profit, but it's quite sensitive to overall the economy. And I think a lot of more bearish people, people who are like, oh, we'd rather, if we're going to take credit spread risk, we'd rather have that corporate beta in equities, and then they tend to use IVOL as a diversification tool.
That makes a lot of sense. Nancy, this is super informative. Thanks so much for coming on and talking to me today. So this is where people can go to get more research and more materials. Also check out worth.com, where we'll be covering these issues. Nancy, this was great. I really appreciate it.
Thanks for having me up, Dan. It's great to talk to you about choices for investors, and it's just it's a very challenging time for markets and for portfolios, and we appreciate the opportunity to educate people about other options.